Venturing beyond the stock market, understanding unlisted shares. We often hear about the stock market, where companies list their shares for public trading. But what about companies that choose a different path? Enter the world of unlisted shares. These shares represent ownership in companies not listed on public stock exchanges. Imagine a private club for investors. That's what the unlisted share market feels like. Unlisted companies, also known as private companies, have various reasons for staying private. Some are still in their early stages, focusing on growth. Others might prefer less regulatory scrutiny or want to maintain control within a close circle. Whatever the reason, unlisted shares open up a whole new avenue for investors seeking unique opportunities. Investing in unlisted shares is like venturing off the beaten path. It's not for the faint of heart, but can be highly rewarding for those willing to explore. This journey requires understanding the nuances of unlisted shares, their benefits and their risks. Let's dive deeper into this fascinating world of investment. Unlisted versus listed shares, a tale of two markets. Imagine two bustling marketplaces, one with bright lights, loud vendors and constant activity, the other with a quieter, more exclusive ambience. The first market is open to everyone, where anyone can walk in, browse and make a purchase. It's a place of transparency and accessibility. That's the difference between listed and unlisted share markets. Listed shares are like goods sold in a public market, highly visible and easily traded, with prices that everyone can see. Listed shares are traded on public stock exchanges, where they are subject to the scrutiny of regulators and the watchful eyes of investors. This visibility ensures a level of trust and confidence among participants. Unlisted shares, however, are traded privately, like exclusive deals made behind closed doors. These shares are not available to the general public and are often exchanged in private transactions. Listed shares enjoy high liquidity. This means that they can be bought or sold quickly and easily with minimal impact on their price. You can buy or sell them quickly on stock exchanges like the New York Stock Exchange or Nasdaq. These exchanges provide a platform for continuous trading, ensuring that there is always a buyer or seller available. Prices are transparent and fluctuate in real time, reflecting market demand. This real-time pricing allows investors to make informed decisions based on the latest market information. Unlisted shares, on the other hand, are traded directly between buyers and sellers, often through private networks or specialized platforms. These transactions are less frequent and can take longer to complete. This difference in liquidity impacts pricing. Listed shares have readily available prices that are influenced by market forces, while unlisted shares require negotiation between parties to determine their value. Listed share prices are readily available and subject to market volatility. This means that their prices can change rapidly in response to news, economic data, and other factors. Unlisted share valuation is more complex, requiring careful analysis of the company's financials and future prospects. Investors must conduct thorough due diligence to assess the true value of these shares. It's like comparing the price of a mass-produced item to a rare antique. The latter requires expert assessment. Just as an antique's value is determined by its rarity, condition and historical significance, unlisted shares are valued based on the unique characteristics and potential of the issuing company. Understanding the nuances between listed and unlisted shares is crucial for investors. Each market offers different opportunities and risks, and knowing how to navigate them can make a significant difference in investment outcomes. Whether you prefer the transparency and liquidity of listed shares or the exclusivity and potential of unlisted shares, being informed and strategic in your approach will help you make the most of your investments. In the end, both markets play a vital role in the financial ecosystem, offering unique avenues for growth and investment.
Navigating the unlisted waters. Risks to watch out for. Venturing into the unlisted share market is like sailing in uncharted waters. The allure of discovering hidden gems is strong, but the journey is fraught with challenges and uncertainties. The potential for discovery is immense, but so are the risks. Just as a diver must be cautious of underwater currents and hidden dangers, investors must be aware of the pitfalls that come with unlisted shares. One of the most significant risks is lower liquidity. Liquidity refers to how quickly and easily an asset can be converted into cash without affecting its market price. Unlike listed shares that can be sold quickly on the open market, offloading unlisted shares can be challenging. The market for these shares is not as active, meaning it can take longer to find a buyer, and you might have to sell at a lower price than expected. It's like owning a unique piece of art. Finding the right buyer at the right price takes time and effort. You may have a valuable asset, but its value is only realized when you can find someone willing to pay for it. Another crucial factor is the limited historical data available for unlisted companies. Without a comprehensive history, it becomes difficult to predict future performance and make informed investment decisions. Public companies have years of financial records and market performance data, making it easier to assess their value. Investors can analyze trends, compare past performance, and make more informed decisions. Unlisted companies operate more privately, making it harder to gauge their track record and future potential. The lack of transparency can be a significant hurdle for investors trying to evaluate the true worth of their investment. Moreover, investing in unlisted companies often requires a higher minimum investment amount. This means that only those with substantial capital can afford to take the risk. This can be a barrier for smaller investors. The high entry cost can deter many from participating, limiting the pool of potential investors and making it even harder to sell your shares when needed. Also, unlisted companies are not subject to the same level of regulatory scrutiny as listed companies, which could increase the risk of fraud or mismanagement. Without stringent oversight, there's a higher chance of encountering unethical practices or financial mismanagement. Investors must be vigilant and conduct thorough due diligence before committing their money. Understanding the company's business model, management team, and financial health is crucial. Consulting with financial advisors and seeking expert opinions can also help mitigate some of these risks. They can provide valuable insights and guide you through the complexities of investing in unlisted shares. Diversifying your investment portfolio is another strategy to manage risk. By spreading your investments across different asset classes, you can reduce the impact of any single investment's poor performance. While the unlisted share market offers exciting opportunities, it's essential to navigate it with caution and awareness. By understanding the risks and taking proactive steps to manage them, you can sail through these uncharted waters more confidently.
Section 4. The allure of uncharted territory. Potential rewards of unlisted shares. Despite the risks, the unlisted share market holds immense potential for those willing to explore. Imagine investing in a company like Airbnb before it went public. That's the kind of opportunity the unlisted market offers. The potential for exponential returns is a significant draw for investors seeking to diversify beyond traditional markets. Early-stage companies with disruptive ideas often turn to private investors for funding. By investing in such companies, you become part of their growth story. If the company succeeds, your early investment could yield substantial returns. Moreover, unlisted shares can provide exposure to niche sectors or emerging markets that may not be well represented in public markets. This allows investors to tap into unique opportunities and potentially higher returns.
Section 5. From startup to stardom, success stories of unlisted companies. The journey of a company from being privately held to going public is an exciting one. It is a path filled with challenges, opportunities, and significant milestones. For many entrepreneurs, the dream of seeing their company listed on a stock exchange is a testament to their hard work and vision. Many household names today started as unlisted companies, attracting early investors who reaped significant rewards. These early investors often take a leap of faith, believing in the potential of a startup's vision and its founder's ability to execute that vision. Take the example of Facebook. In its early days, it was just a small project in a Harvard dorm room. Mark Zuckerberg and his team worked tirelessly to grow the platform, attracting millions of users and catching the eye of early investors. Before its IPO in 2012, Facebook was a private company. The anticipation leading up to its public offering was immense, with many speculating on its potential market value. Those who recognized its potential early on and invested in its unlisted shares benefited immensely from its phenomenal growth. The IPO was a significant milestone, but the real rewards were reaped by those who believed in Facebook from the beginning. Another great example is IKEA. Founded by Ingvar Kamprad in 1943, IKEA started as a small mail-order business selling household goods. The Swedish furniture giant remained a private company for decades, allowing its founding family to retain control and reinvest profits back into the business. This strategy enabled IKEA to expand globally, opening stores in numerous countries and becoming a household name. This long-term vision paid off, making IKEA one of the most valuable retailers globally. The company's commitment to affordability, design, and sustainability has resonated with millions of customers worldwide. Bloomberg, the financial data and media giant, is another example of a company that thrived as a private entity. Founded by Michael Bloomberg in 1981, the company revolutionized the way financial data was accessed and analyzed. These success stories highlight the potential of investing in unlisted companies. Early investors in these companies often see substantial returns on their investments as the companies grow and eventually go public. However, it is crucial to remember that not all unlisted companies become success stories. The journey from a startup to a successful public company is fraught with risks and uncertainties. Thorough research and due diligence are vital before investing. Potential investors should evaluate the company's business model, market potential, and the competence of its management team. By doing so, they can make informed decisions and increase their chances of investing in the next big success story.